Hey, all right. Good morning, everybody. Short week for the next 2 weeks. Kind of get used to it. The lack of participation can cause markets to behave in unusual and erratic ways. So, if this is your first holiday season trading, perhaps just keep your money in your pocket. I know it's nobody learned to trade just to sit out and not trade, but you don't get do-overs. NASDAQ is up the most at 0.5% with small caps right behind it. We're still watching that dynamic between the small caps and the NASDAQ. So just continue to keep your eye on them. You don't have to sit and watch it all day. We're just looking for that other kind of pre market where we were seeing small caps leading through the overnight and then kind of taking a backseat in the daytime. It's something that you always want to keep your eye on when we see this transition from growth to value and we have like hedge fund factor rotation and the possibility of small caps and short squeezes, all that good stuff. It's a it's a regime that swings around once or twice a year. It doesn't last long, but it's useful to see it when it's happening. Otherwise, we got a little bit of a split between the S&P and the NASDAQ. Not much, not even 0.25%, but these two usually match each other really well in percentage point. So if the NASDAQ is up at 0.5 and the S&P is closer to 0.25, then it's going to either need to catch up with the NASDAQ or the NASDAQ's got to catch down to the S&P. The Dow doing its own thing, dragging its feet. If we're looking for any sort of push in the Mag 7, then blue chips, unless they're being weighed down by something specific, which, the math behind the Dow and its index parameters, they're different than the S&P and the NASDAQ. So it can be weighed down by something like Walgreens. Nuts. Europe down 0.5%. Japan closer to 0.25. So it's a little soft out there. What we want to see is how the rotation turned from Asia into Europe into the US. And are we going to end up spread like Europe, or have we started to turn things around since Europe's open? Revived appetite for technology stocks, powered gains. Mm-hmm. Copper and gold set records. That's the European market wrap. If you don't know about it, Finance Juice does a pre-market briefing and a market wrap for the three biggest markets. So Europe, Asia, the US. It's really handy to see, and Europe's not closing yet. They're really gracious. They're giving us a Europe wrap early so that the US traders who are coming in can see what was going on in Europe, even though it's still got hours to go. So it's a nice little pick me up just to see what was going on while you were sleeping and to perhaps identify what Europe was focused on because it can bleed into what we want to focus on. After the day is done, this is a good source to come back to see what moved US markets. Most of the time we know, right? But sometimes we get a market day, we're like, what the heck happened? Why did price move like this? So come back in here after the market. Usually takes them about an hour or so and see the market wrap. Get some clue as to why the U.S. market moved. As you can see, we got some auctions in the front end. Should be able to just run that through IRX. Other than that, we don't have much today. And that's kind of the expectation for the week, right? No real shock and awe other than some auctions. I have to say, I would rather have had a gap down to start the week than a gap up to start the week. But that's all right. Gaps are bullish or bearish, depending on if they're going down. And you want to read them for what they are. The concern is what kind of gap, because there's a lot of different gaps. Breakaway gaps, exhaustion gaps, capitulation gaps, earnings gaps. So gaps aren't just one little thing, right? We're not up at the highs, so this gap isn't that bad. It's not an earnings gap, obviously, as we're looking at the futures. But we do need to make sure that it plays out. We are through all of the major moving averages, so we don't have that in our way. We're outside of this control bar that had been dominant through the late part of last week. And we're outside of yesterday's big bar. So we need to keep it. One of the concerns now is this breakdown bar. $69.14. We're coming right into it, actually. 69. Let's just put it over here on the intraday. That way, right there. Let's just round it up and call it 69.17. So get there, get through there, keep it. We can make our way back to the top. We talked about last week a TRB or a scoop pattern. The idea that when you get a run like this or a move down, that once you build a base, you're going to be looking for the move back up. And there's a couple of things that we really need answers to. And we just have to wait for them to play out. That dominant high back here, we set a lower high just from that alone, right? So depending on how you're doing your analysis, that's a really big deal. But we had that high, and this one is higher than that. So we're turning things around, so to speak. But bringing everything closer to this side, on this run down, you get a TRB where we have 1, maybe 2 days of sideways, and then just this massive rip back to the top. 1 bar, maybe 2, and that's a TRB back. If we just work our way back up, smaller bars, more days, and we make it back to the top eventually, then this would be more of a scoop pattern, like a cup, possibly a cup with a handle. That would be for a later analysis, but it wouldn't be a TRB. Either way, it would be a run back to the top. Now, when we say top, we don't necessarily mean draw a line up there and expect price to go to the tippity top. We're looking at the general area, and I would focus on the distance between those two lines. Makes a nice little zone. It's clearly visible. That would be the resistance zone of concern. Highlight that area here. Between 4 and 5 p.m. on the 11th, after the 4 o'clock close where the smaller accounts had to stop and the institutions were still running, or bigger account traders, until 6, we had that last little bit. So we know what kind of traders those were. We'll see if they want to defend that level, if we can even get back up there. We need to make an equal high at the bare minimum, and or breach that high, get a new high, and preferably make an equal high with this one, 70.10. If we can't match that high or get higher than that high, then the concern is that we have to come back down and put in another higher low. This is the only low that we have right now. Since we've reversed, usually we would set, higher high, higher low, higher high, higher low, and we'd be working our way back up. This is our only one. So we need to resolve this high and this low. And it's not a guessing game, which is where a lot of newer traders just seem to not understand this. And I get questions all the time. What are we doing? Are we going up there or are we going to go down there? Hey, I can guess just as much as you. If we're just guessing, let's flip quarters and take shots. But it's only a guess. There's absolutely no way to know for sure which side of that we're going to hit. And it's not a dichotomy either. I mean, we can do both. We'd still have to figure out which one we're going to do first, but we can do both. But in the bigger picture technical analysis, whichever one we do is going to really account for what's going to happen after that. If we set this as a lower high, then we're going to be looking to set this as a lower low. It doesn't have to, right? Price can do whatever the hell it wants. But that would be the base case argument. What would be perhaps healthier or more appropriate would be if we break this high and set a higher high, even if we don't challenge this previous high. Because a higher high would give us a chance to come back down and set a higher low, and then perhaps the strength to get through that 7,000 level. Because that's the concern I have at the moment. Running from 6,800 to 7,000 in a single shot, and then getting above 7,000 and keeping it, that's a tall ask. It's a lot to ask for. What would perhaps be stronger, more believable, sustainable would be if we can breach that high with a new high, come back down, set a higher low, and then from 6,900 or even from, say, 6,950, get a run at that 7,000 again and get through it with some fuel in the tank. Gaps often get closed. Now, different analysts handle gaps differently. I'm not saying that I am right and they're wrong. I'm just saying that there's a different style for everybody, right? The main thing is consistency. So a lot of analysts are going to say, if we touch this candle in any way, that gap is closed. That's all it would take for price to just come down, tag the line, and we're done. Me, I'm a little pickier. Now, since the close of Friday is so close to the top of Friday, my way and their way is really off by like 2 ticks. It wouldn't matter. But you could imagine that if it was one of these days where the close was a long ways away from the top, if we were trying to close that gap, we would have a lot of work to do, and there would be a big difference between my way and their way. Either way, if we closed at that red line on Friday, then the gap is not closed until we go back to that red line. That makes perfect sense to me, right? It's not like I just made this stuff up while eating cereal. If that's where we left and we opened somewhere else, then we have to go back to that spot or the gap is still open. Going down there to hit that level, by the way, would not be bearish. I know it might seem bearish. You see price going down, but we wouldn't read that as bearish. That would just be price doing what it's supposed to do, closing the gap. We need to stay above that line right there. So if we get back inside of Friday's range, this is the line that we want to pay attention to. It's the half back of this move. kind of need to keep it. $46,000 in the overnight. It's a wee bit light. It's not as bad as it sounds. Sitting in the mid 50s would be our norm. So sitting in the mid 40s is just slightly off. It's the first day of the week though. And the expectation is that as the week goes on, the lack of participation is going to increase significantly. So we'll see what it looks like tomorrow, right? It's not a 5-day week for me. I'll be here Monday and Tuesday, and then next week I'll be here Monday and Tuesday. That's it. We've got a 75-point average daily range. It has shrunk considerably because of how much time we spent sideways. It's all based on math, right? So we've got a narrow range. The expectation is that we stay inside that range. We really don't have any reason to believe we're going to break out and run yet. We'll continue to work through this briefing and see if we've got any triggers that could get us there. We don't have economic events that can do it, so those are off the table. Headlines from gotcha or just news that we don't know is coming, that can do it. Maybe some 0-day flow and the options were not open yet, so that we wouldn't have that. Mag 7 and banks, it's absolutely possible. But that would all be a little deeper in. The ADR half on the downside would be easier to hit simply because it's within yesterday's range. The problem is we're not within yesterday's range. We're inside day breakout. So as long as we keep the breakout and we don't close this gap right here, then the upper one is easier to hit because we don't have any resistance to worry about or any pivot points to worry about. So 69.42 old school cog line would be the upside target. Then we'll see. Today's floor pivot is higher than yesterday's floor pivot. That's bullish. Price opened above it. That's also bullish. But we have this expectation that price wants to hit that pivot point. So if we break our own Globex low, then we want to get back inside of Friday's range, back through Friday's close, then through the top of the channel, and then down to the daily floor pivot. We are above the weekly floor pivot, and that's also bullish. So far, we have a MDP that's a missed daily pivot, but it won't count as a missed daily pivot until tomorrow when we look back and see that we did not ever hit that pivot. And then we say, hey, we didn't hit it. It was a missed daily pivot. For now, it just hasn't been hit, quote, yet. As far as we know, we're going to hit it. That right there gives us a little bit of a bias to the downside that suggests we're supposed to come down here and hit it. That doesn't necessarily make us bearish, by the way. Just a part of the wave function, what price does. So we are nearing that 69.20. It's the S1 at R1 combo, right? So S1 down here, R1 up there. The idea being that if we get to R1 and we can't get through it, that puts S2 on the table. If we can get through R1 and close above it, say on a 30-minute or a 15-minute, then it opens the table to the next level, 69.45. And if there is a third up there, that would be extreme bull. But R1 S2 is common, or S1 R2 is common. We really want to be watching this level for that rejection and see what we're going to get. Today's a wide channel day. Wide channels typically imply that if we break out, it doesn't stick and we come back in again. Well, we already did break out. So that wide channel says this breakout is a failure and that we're going to come back. But remember that these channels don't make price do anything, and we don't have to come back. R1 is farther away than S1. The indicator itself is implying that up is the preferred direction, or it's the most likely outcome of today's moves. And this week's floor pivot is not much higher than last week's floor pivot. Really, I mean, not much change at all. And it looks like the channel is just a little bit wider, but it's such a small amount that it's not even worth considering the impact of it. Yeah, it's just slightly bigger. So on the week, we didn't get much change on that weekly pivot. We're still above it too, and we're not extremely above it. We do need to be concerned about how far price gets from that weekly pivot. And the fact that we're opening gapped up away from it does matter, but not on day one and not this far. This isn't far enough. Let's get 2.5 to 3% away from that weekly pivot. Then we'll be a little more concerned about mean reversion and least squared methods. Sure does look like a TRB to me. We just need to giddy up. So we got a really nice classic profile, but it's, first day on a weekly profile. There's just nothing here yet. Simplified distribution. We're above last week's point of control. We're outside of last week's value area. And the week before that is an area of concern. So we just shoot back to this point of control from 2 weeks ago. We're negotiating with it right now. We do not negotiate with terrorists. We'll see if that holds. 69.11 cog line from 2 weeks ago. We talked about this zone a little while back. I think it was like Monday or Tuesday of last week. These 2 points of control kind of make a little zone all of their own. And that's where we're at right now. If we can get through this zone and get above it, that should act as a fairly decent support structure. Problem is, we got to get through there first. Get through it, own it, all that good stuff, right? Take its lunch money. Ten-day, 30-minute volume profile in TPO. And the TPO's point of control is above 6,900 and the volume profile is still below, but that is the zone and it gets really shallow right on the line. That makes sense because we see them front running it from both directions. If we lose 68.92 cog line, it's more likely we're going back to 68.50 and then 6,800, 67.50. We're going to work our way right on back down again. And the reason for all of that is just that price dynamic, right? That idea of price making its way down. That's what we would be focused on. Just like it did back here, right? In fact, we could just copy paste all of that with this as its starting point and it would look the same way. That's if we break that 6,900, get below 68.92 cog line. Otherwise, we're still focused on getting back to this high and those 2 hours on that breakout. So let's get through that. The point of control here is not likely to move much. We could come up to match the volume profile this week, but dancing between these two isn't going to be very relevant to us. We're looking for a new home, and at least this week, no expectation that this point of control is going to get outside of these two areas. Maybe into the new year, we could have that profile down around 68.50, but that's next year's problem at this point. We have a new VPOC. We'll just take this line back here. That's Friday's point of control. So far today, we haven't hit it. So if we do begin that move to the downside, break our own Globex low, get back inside of Friday's range, close the gap, and then focus on the VPOC. That Friday is a classic P-shape profile with a very high point of control. All right, last week we examined the anticipated or projected expected move, and it was a little wide at the time. Which kind of gives us some insight. One, it won't be wide if we have known unknowns on the table. CPI, PPI, non-farm payrolls, FOMC, those are all known unknown events. We know the events are coming, we just don't know what the numbers will be. When we get really wide ranges, that says the market's worried about something, but it's not one of our regular institutional plays like the CPI, PPI. It would be something else that the market's worried about, which lands more into an unknown unknown. They're upset about something, or they're concerned or nervous. They're ratcheting up their hedges and protection. They just don't know what's coming. This range, it's not that bad, really. We compare it to an FOMC week. FOMC week is narrower because that's a known unknown. And then even the week before that, we're just about the same. So this week doesn't look like we're all that extreme. But here's the problem. It's a short week. They priced in the same amount of volatility as the week before FOMC with less days to get the move done. Here's the best way to put that into analogy. If you're driving 80 miles an hour, you can travel 80 miles in 1 hour. What if I make the same 80 miles, but I do it in 45 minutes? Because I don't have an hour. I've only got 45 minutes. I still got to make the same 80 miles. Well, then I'm moving faster. So if this is how far we could run in a 5-day week, and we say, yeah, we can make the same distance, we can just do it in a short week. Instead of, quote, miles per hour or speed or velocity, what we're measuring is volatility. So the volatility is higher, right? Much higher. If I make that 80 trip and I do it in a half hour, That was going pretty damn fast. All right, looking at things that are down today. The Mag 7 down volume is down. Yes, that's a double negative. And really, that's all we got. Looking at what's up, everything else. There are a couple that aren't necessarily moving around that much, like communications and financials. Airlines, cloud computing. So those aren't really getting any attention yet. But we've got the Mag 7, China, solar, energy, mags again, uranium, quantum, robots, chips, nat gas, metals and mining, UFO for the small caps. We've got just about everything we could want. Bitcoin. So we have the capacity for a rally day simply because of the breadth of the market. Everything up. It's that rising tide that lifts all boats sort of scenario. The problem is that doesn't have to equate to a move in the indexes. It's rare, but it happens where we get this equity flood and all the focus is on the various equities out there. And then we see the S&P and the NASDAQ just kind of go sideways and chop about, get up into new high a day or new low a day levels, but not break out and keep anything. So precious metals, top of the list. Bring in the Bitcoin after that. Crude, chips, pot stocks, uranium, then the Mag 7 and more generic tech and China. We could see some of that take a backseat or just start to calm down, but it can't turn negative. So if they're up and, green to red is not going to be good. But if we can just toe the line and stop from going green to red, that's all we would need for the indexes to get a breakout rally day. There's no reason to think that we're going to get it yet, but I wouldn't plan against it, right? So, like it always is, GTFO, we got to get out of the box. The box that we're going to have to get out of first is our own Globex range, and it's doing it now. So that works. Continue the expansion to the upside. Once we get into the RTH, the regular trading hours, this is the box that we have to get out of. So if we were opening right now at 9:30 and we started to drift to the downside, that would be the box. Otherwise, if we opened here at 9:30, like right now, and we broke out from there, then hey, we're out of the box. Get out of the box before you do anything else. So this Globex range will be the first box. If we break to the downside and we get out of that box, get back inside of yesterday's range, deal with the close, and then yesterday's midpoint, and then we'll focus on all of yesterday's low. We got the RTH low and then the quote real low, and we'll focus on lower levels from there. If we keep this breakout, which may include coming back down and bouncing on yesterday's high, if we keep the breakout, we'll look higher. And we've already got the higher levels, right? 6950, 7000, and then 7050. No kidding, right? Technically, we could do it today, but there's absolutely no reason to expect we're going to do it today. Just remember the TRB is one of my favorites for a reason. It's because we get back to the top in one day, maybe two. So getting all the way up to 69.92 cog line, it's not off the radar. Be very careful this week, guys, right? Portfolio protection should be high on your list. This is not the time or the season to try to really make big plays. Be careful, be safe. I'll see y'all tomorrow.